Good day. Today we're going to be looking at IS 1, and IS 1 talks about presentation of financial statements. Now, we've taken care of a whole lot of topics in our previous classes, and now we're going back to the first standard, and that is IS 1. So now we are going to be learning how to present financial statements, and the topic of IS1, or the name of IS1, is presentation of financial statements. Now we're in this lesson we're going to have the aim of setting out the form and content of financial statements to be presented. We're going to be doing a whole lot, from learning the definitions to taking formats and also general notes. So we'll be going into the lesson right now, and the first part we're going to take is a personal definition I gave to the term financial statements. Now it says, what are financial statements? So from the name we could see, or we could know, that it is not just a single book or a single paper. We have a group of them, statements, plural form. And here it says financial statements are records of financial transactions and material non-financial records. Now, the fact that we are already used to the financial transactions, we would also find out that financial statements also contains material, means something that is substantial. Non-financial records, that's qualitative records, the written parts, explanations, notes, they are also parts of financial statements relating to an organization that has occurred. Now, it has to have already occurred. If it has not occurred yet, then it's a projection or a budget or any other thing we call it. But financial records have occurred over a period. Now there's a defined period that it covers, from so date, say 2011 to 2012. That's 1 year financial statements during the operations of such entity. Now the entity must be in operation, it must be trading, it must be going on with its business. So now we say that a complete set of financial statements consists of, we're going to be listing the required financial statements by IAS or IFRS now, and basically we would find out that there are 5 of them. Please, we should jot down some things, especially the areas highlighted in green and say yellow. We should jot down them because they are quite important. So now we found out that there are 5 of them that are clearly stated, although you could add extra, which we'll be looking at later further down. But we'll list the 5 of them here. We have the statement of financial position as the first one, a statement of financial position at the end of the period you are reporting for. We have a statement of comprehensive income for the period, and here the statement of comprehensive income has 2 parts. It's divided into 2. It's a 2-in-1 statement. Now you can group it as 2 or you can group it as 1, but in general both of them are still under the statement of comprehensive income for the period. We have the statement of profit or loss, and also the second part is the statement of comprehensive income or other comprehensive income, it's supposed to be. The other comprehensive income simply means and others. So um we have a statement of changes in equity for the period as the third distinct one required by IAS to be presented as part of financial statements. Then we have the statement of cash flow as the fourth. Then finally, we have notes to the financial statements. Remember, we said earlier that financial statements are not just quantitative writing, that's calculations on what has happened. It is a form of presenting stewardship by the management to the shareholders. So you're trying to explain, okay, we are running this business on behalf of you, the owners. So you, the owners, have right to get every single detail, every single material detail of this business for you also to make decision if you'd want to stay as the owner of the business or you'd want to leave, that is sell your shares. So now with these five, the standard and in general IAS has covered the financial statement, but there are few extra to add, and that is the comparative information with respect to previous periods. You can do it for each one of the four. Notes do not have comparative information, although you could reference info that is substantial from the past. You also have a statement of financial position as at beginning of the preceding period when an entity applies an accounting policy retrospectively or retrospectively restates or reclassifies items. Now that is when there is probably an error or a change in accounting policy. So would perform that correction retrospectively. Then we'd move on. You'd have to retrospectively means previous period. You'd have to correct them or change them, and in correcting them you'd also have to display them. You also have to show them in with your current statements, your current period statements. So that's another reason why you could display two statements of any of the five listed or any of the four listed above. Then we'd move over to the statements of financial position now. Now this is the first statement here that we have here. So it goes on, it says the statements of financial position cover the records of assets, liabilities, and equity. Now we'll be taking each one of them, the definition of each one of them, in case we're novice with the terms used here. You would also be expected to be carried along. So it says assets. Assets is a resource controlled by the entity as an organization, a corporation, as a result of past events and from which future economic benefits are expected to flow to the entity. Now, this definition was gotten from ISB framework, International Accounting Standards Board's framework. A resource. The areas highlighted in green are very important in the definition. Resource controlled by the entity, past events, and future economic benefits are expected to flow to the entity. So now we look at liabilities, the definition of liabilities, and it said liabilities are defined as a present obligation of the entity arising from past events, present obligation from past events, the settlement rather of which is expected to result in an outflow of the entity's resources. So we have present obligation, past events, settlement of which is expected to result in an outflow of the entity's resources. So now we have equity. Remember, we're told that the statement of financial position is broadly listed into the assets, the liability, and the equity section. Now, the assets, the total assets, is equal to the total liability plus your equity. Now, that is the accounting formula there. So, both of them, or rather, the three of them, must balance up. That means must be equal to each other. Total assets must be equal to your liability and your equity. So we have an any contract that evidences a residual interest in the assets of an entity after deducting all its liabilities. So we'll take the area highlighted in green here, and it says a residual interest in the assets of an entity after deducting all its liabilities. So we'll be doing a little bit of maths here. Remember, we said assets is equal to liability plus equity. Now, if we want to get equity, we'll say equity, we'll move liabilities to the other side. Equity is equal to assets minus liability. So let's see what the definition says here. A residual interest in the assets after deducting liabilities. So we're right. Equity is equal to assets minus liability. So how did this accounting formula come about? The accounting formula came from the fact that a business is financed by either the shareholders or borrowings. Now, those are the two areas where finance can come from for the business to finance buying assets for the business. Once you have money for your business, you buy assets, you buy goods, stocks to sell, you rent your building or you buy your building. Either ways or any ways, you would still have to generate your money from either the owners of the business or from borrowing. Now, the borrowing aspect is the liability section, while the financing from the owners of the business is the equity section. So you could say that assets is equal to your liabilities plus your equity. Now that's how the formula came in general, not in details now. So let's say items in the statement of financial position include, the first is, we'd already listed them out, but we'll just be checking out some of them in detail. So we have current and non-current assets and liabilities. Now this sentence or this phrase consists of four things. First, the current assets. Second, the current liabilities. Third, the non-current assets. Fourth, the non-current liabilities. So from the name current, non-current, current has a lifespan of a year or less than that, while non-current has a lifespan of greater than a year. So that's basically the simple distinction between both of them. So we say IS1 required an entity to present current and non-current assets, current and non-current liabilities as separate classifications on the face of the statement of financial position, unless a liquidity presentation provides more relevant and reliable information. So it says, okay, you could present based on liquidity. Now, liquidity is the cash, it's basically cash. So, how much cash do you have at a particular time? And here, saying providing information based on liquidity says, okay, each item you have, you place it in a order, in an order rather, in an order that in the order of which that item can easily be converted into cash. Now, how easily or how easy rather an asset can be converted into cash determines its level of liquidity. Now, goods stock, they are very liquid because okay, you could turn them into cash, you could sell them and you get cash instead. Then fixed assets are a little bit lesser in liquidity because okay, before you'd see a buyer, it would take time. There'll be time to see the buyer, there'll be time for documentation until sales is made. So there's a little gap, there's a broad gap there. So we could say, okay, stock is a little bit more liquid than fixed assets, especially fixed assets that are not common or that are specific to an industry. So that's basically the explanation on liquidity now. So it says, in such cases, all assets and liabilities must be presented broadly in order of liquidity. We've said that some items may be presented using the current slash non-current distinction and others presented in order of liquidity. So we've given the current and non-current 1 year, less than 1 year, or based on how quickly they can be converted into cash. Those are the two ways you could use. So it says if the information provided is more relevant and reliable. So it's based on relevance and reliability to the shareholders, how it makes them have informed decisions on time, how relevant it is to them in general. So it says whichever method of presentation is adopted, an entity must disclose the amount expected to be recovered. That means whichever method you use, either current or non-current, current non-current method, or the liquidity method, you are expected to disclose the amount. The amount must be there because that's why you're even disclosing it. So as a line item, now the definition of line item is basically just putting it there, say assets here, the amount, rather than accumulating it and saying, okay, if I put, I'll give an example now. If I put an example of my bed as a line item under assets, I'll put bed, put whatever I used to buy the bed, the amount there, or the value of the bed currently, I put it by the side. That is a line item compared to putting the bed under furniture. I aggregate it with furniture, then I put furniture. The bed is no longer a line item there. So that's basically it. So we'll go down and it says additional line items for understanding is not prohibited. So you could put based on materiality, and materiality is based on size and importance. So it says additional items could be in form of, we have additional line items on the statement of financial position. I gave an example of my bed. Then notes to the account, you could write it under the notes to the account, another separate part as we mentioned before. So we go to the second component, equity, and it says equity comprises of line items of, under equity you'd see authorized ordinary share capital. The green part is what we need, share capital. Let's see retained earnings. Let's see reserve. Share capital is the cumulative sum of capital paid by shareholders in the business, while retained earnings is also the cumulative sum of past profits that are attributable or attributed to ordinary shareholders. So it's a accumulation rather of past profits plus the initial payments by shareholders to become part of the owners of the business. The value of their shares now plus whatever they've derived as profits from the initial period down to the present. Then reserves, we have them there. So that is the value of equity. So, and remember, equity is the amount for the shareholders, for the owners of the business. So now I think we have a format here, and this format was gotten from a site which I would reference down after it. This is the format of your statement of financial position. You have fixed assets, renovation and improvement, less accumulated depreciation. Be doing that. This is the presentation, how to present it based on IAS 1. So we have line items here. An example of a line item is cash. Another example is prepaid rent, then inventory. Have them here. That's the total assets figures. We have liabilities here. So we have general heading, assets here, liabilities here, total assets, total liabilities. Then total liabilities and shareholder equity is equal to 96,650. Then the total assets is also equal to 96,650. So there's a balance there. According to our formula, we said assets is equal to liabilities plus equity. So we're correct right here. Then we go down. The format was gotten from studyfinance.com. Shout out to them. So we have the next one here, and it says statement of comprehensive income. And remember, we said that statement of comprehensive income is a two-in-one account. It has the statement of profit or loss, and it has also the statement of other comprehensive income, which means and other income in layman's sense. So, statement of profit or loss, it contains a list of income and expenses, which in turn results to profit or loss for the period. So your revenue, that's income, less your expenses, would give you profit. So that's how we got the name profit or loss. So basically, you could say inside the profit or loss statement, you have your revenue, and you have expenses, then you have profit. The profit is the main thing. How do you get profit? Revenue less expenses will give you profit. So that's basically what's inside the profit or loss statement. So the statement of other comprehensive income, a list of gains and losses that have arisen. So basically, this is the additional side to it: gains and losses that do not occur in the ordinary in the ordinary trade, or in the ordinary trade, or the business, or the ordinary environment where the business occurs. So we'll be giving examples there to make us understand that better. And it says you can present as one. IAS requires that you present as one or as two, but with clear indications for both. So you could present them together, but you make a clear indication there, or you could present them separately. There's nothing wrong in both of them. So it says additional line items could be added in the source here, statements of comprehensive income, just a short form there, when it is relevant for understanding. We know the meaning of line items. So it says information shown as line items in the source or statement of profit or loss as notes. So we have material items of income and expenses. Then we have analysis of expense, providing analysis by the nature, the function that incurred them, information to be presented in the OCI. OCI stands for Other Comprehensive Income. Other Comprehensive Income, OCI, also presents line items for income in the period, e.g., so this is what is in the OCI. revaluation surplus on PPE, revaluation surpluses on intangible assets, remeasurement of defined benefit contribution, gain or loss on retranslation of foreign operations. Then we have gain or loss recognized on remeasurement of available for sale assets. So the reason why I highlighted these areas, we would notice something. There's always a re in front. Revaluation, revaluation, remeasurement, retranslation, remeasurement. Just the last one, but it basically still means re something there. So remember, I said not in the line of the ordinary course of business, of the ordinary trade or course of business of the entity. Those gains are recorded in the OCI. Now, the statement of profit or loss takes income from normal trade of the business, while the OCI gets income from other sources like revaluation on surpluses. You value your assets and you found out that okay, this asset is currently higher than what it thought it was. So we have a slight gain there. We have a gain there on the assets. It's not like we trade on that asset. It's not like we sell that asset. So that gain is kept in the OCI. That gain we get is kept in the OCI. So we have a look the REIS, revaluation, remeasurement, revaluation, remeasurement. Then we put them in the OCI, especially for PP, intangible assets. Defined benefits has to do with pensions and gratuities. Then foreign operations, gain on retranslation of foreign operations. We have exchange rates differences. Sometimes exchange rates fluctuate, go up, come down, go up. It's not as if we sell those exchange rates. We gain from, let's say, when the exchange rate between the US dollars and the British pounds go up, and we gain, we didn't sell anything during that period, and we have a foreign company there, so we just have that gain as part of the OCI. So that's basically what it is there. So we go on to gain or losses recognized and remeasurement rather of available for sale financial assets. Then gain or losses recognized in effective elements of cash flow hedge, still part of foreign exchange. So we have a format here, and this is the format: sales, cost of goods sold, gross profit. We have the gross profit. Sales basically brings income less cost of goods sold, which is basically an expense. So we have general expenses here now, like the operating expense, selling expense, advertising expense, commission expense, admin, all the total expenses. We have operating income as the difference. Then non-operating or other interest revenue or other OCI. We have the rest there. Then your net income down here. So that's basically all on the presentation on the income statement. So we'll move over quickly to the third, which is the statement of changes in equity, and it shows the amount of equity component at the beginning of the period, changes during the period, and amounts at the end of the period for each component of equity. Not beginning, changes, then end. Start, period, end. So it shows anything that increases or decreases equity component that is attributed to the owners of the business. So it's basically a big deal for them there. So SOCI shows profit gain or loss for the period, profit gain attributable or attributed to ordinary shareholders would affect it by increasing it or decreasing it. Then we have each item of OCI is also a gain. Then transaction with owners in capacity as owners. So The whole lot of grammar there is a little bit easy. So we have new issue of shares. What are they? New issue of shares. If you issue more shares, you'd have an increase in your ordinary share value, and it will also increase your statement of changes in equity. Like the name, changes in equity, ordinary shares is an equity. So if ordinary shares is increasing, a statement of changes in equity too will be increased. So payment of dividends will reduce your value. It's going out of the business. You are paying your shareholders. So it's basically reducing your equity value, your total equity value available. Then repurchase or cancellation of shares. The same way, repurchase, the company buys it back from the shareholders. So it's reducing the amount of shares. Cancellation also reducing the amount of shares. Changes in respect to equity settled share-based payment. Now, share-based payments is basically a debt turning into an equity, or a debtor becoming a shareholder, and a shareholder is an owner in a business. So this gave me a tough because of the big words used in it. Is basically, okay, you are owing me, so you'd invite me that, okay, rather than giving you this money, say $200 or 200 naira, why don't you use that 200 naira, or why don't I give you 200 naira worth of shares, 200 naira worth of ownership in my company to pay for that debt, rather than giving you the physical cash or transferring it to your account. I'd be like, okay, as the creditor now, I'll be like, okay, I accept. Rather than take the money, I'll take shares in your company for the amount you owe me. So that's basically it. That's share-based payments now. Or it could come in different forms, changing debt to equity. So, and it has here that it says transactions with owners, that should not have an apostrophe, with owners in their capacity as owners are not gains or losses. They are not gains or losses, and therefore are not shown in the statement of comprehensive income. So see, but they do affect equity. So see highlight such. Then we have a format here, and the format is down here. Okay, so we have the balances, previous balance at the beginning. Remember, we said at the beginning, changes, and at the end. Beginning balance as at 26 September 26, 2015. So we have the changes, income, OCI, dividend payments. We have repurchase, that like we said, share-based compensation, like we said, common stock issue, shares issue, like we said, benefits, like we said also. So we have the changes down here, down till the end of the period here, 20. So we had, I think, a combination of years here. They gave us 2018, 2017, 2016, and 2015. So if it was just a 1 year period, we would have just had one down here. So that's the format that we have there, and we got this format from www.doubleentrybookkeeping.com. Shout out to them. And the next we have here is the statement of cash flow. Now it says a statement of cash flow, a cash flow statement, also known as the statement of cash flows, is a financial statement that shows how changes in balance sheet accounts and income affect cash and cash equivalent. Now, the main thrust of everything about the statement of cash flow is on liquidity, cash and cash equivalent. Remember, I said liquidity is how quick or how swift an item can be converted into cash, how easily it can be converted into cash. Now, cash is very good or very useful for settling debts on time. Someone comes and I want to settle the debt that I'm owing him, I'll just give the person cash instead. I'll give the person cash. So that's how it works. A low liquidity, that means the um, entity's value is tied to items that are not too liquid, could affect the entity. It could affect its ability to pay debts on time, which could lead to litigation. Litigation is court settlement and eventually the closure of the business if it's too bad. It could get to that. So that's why liquidity is very important. And IAS pays attention to it by giving it a whole financial part of the financial statement to be presented in form of the statement of cash flow. So that's why we know why statement of cash flow is very important. And it says and breaks the analysis down into operating, investing, and financing activities. So we have the three of them here. We go down, then we have the format here. It says net income, add back depreciation. Depreciation is not an actual cash expense, so it is added back to it. Cash flow is concerned with only actual cash inflow and actual cash outflow. So we have changes in working capital. We have this. This is the format for the cash flow statement. So we have the closing here. Then we move over to the final and the fifth one, which is notes to the financial statement. And it says notes contain information in addition to that presented in the other statements, the four previous ones. Notes is the qualitative aspect of it. Like I said earlier, that financial statements do not just consist of quantitative calculations but also qualitative writings. Then we have notes provide a narrative description of items in those statements and information about items that do not qualify for recognition in those statements. They also explain how those statements are formed. Disclosure of accounting policies. So we have disclosure here. What do you disclose in notes? What do you write about? What do you talk about in the notes? You can't discuss family business in the notes. So here, that's just on a lighter note. So here we have the measurement basis. We have the accounting policies used for the financial statements, the other quantitative aspects of the financial statements. Then we have the judgments made by management that have the most significant effect on the financial statements. And we have what do you disclose about assets and liabilities now? Have the nature, carrying amounts, we have the explanation on any changes if it is very significant. Then we also have other disclosures you could make, like the future interest rates. You could make the disclosure to the shareholders in this aspect. Okay, interest rates are expected to increase in the coming 6 months. So we have to do this, we have to do that to avoid any hurt to our business. Future changes in prices affecting costs, future changes in salaries, useful lives of assets, especially qualitative information. Then we have something that is also important, interim financial reporting. Now, from the name interim means it's not yet full, just part of the process. You go with it. So it says IS1 requires preparation of financial statements, that's FS, at least annually. Many countries say half a year, like the UK, the United Kingdom. So it says interim financial reporting does not specify the frequency, it does not tell you how many times, but rather gives you guidance on how to report when you are reporting during the period. Public companies are encouraged to prepare and present interim accounts not later than 60 days after the interim period. So let's say you're presenting 6 months each, that's half a year. You have 60 days to present the account of your previous 6 months. 60 days grace to present. You are encouraged, it's not compulsory, but there's a period for it, 60 days. Then it says it should have the condensed form of your statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flows, and explanatory notes. The five of them there complete must be in condensed form for the 6 month period or for the quarterly reports or whatever monthly reports you do. So that's basically the end of IS1 presentation of financial statements. Hope you enjoyed it.